This is the story of 8 days in March 1933 when every single bank in the United States was forced to close, and how that one drastic decision may have been the only thing standing between American capitalism and total collapse. When Roosevelt took office, 1 in 3 American banks had already failed, a quarter of the country was out of work, and ordinary people were doing something that would have been unthinkable a decade earlier. Burying savings in tin cans in their backyards, stuffing cash under mattresses, lining up at dawn to pull out whatever was left. The system wasn't struggling. It was in freefall. The trouble didn't begin with the stock market crash of October 1929, though that's where most people start. The rot in the American banking system went back much further, and it had been hiding in plain sight for years. Throughout the 1920s, an average of 635 banks failed every single year, and almost nobody paid attention because these were mostly small, rural, single-branch institutions. Most states didn't allow banks to operate more than one office. There was no federal deposit insurance anywhere, and only 8 states in the entire country ran any kind of deposit guarantee fund, which meant that if your bank failed, your money was simply gone. When the stock market collapsed on Black Tuesday, October 29, 1929, it didn't immediately destroy the banking system, but it cracked the foundation badly. Within the first 10 months of 1930 alone, 744 banks went under, and then the collapses started feeding each other. By the end of 1930, 1,350 banks had failed in a single year, and that number kept climbing. One collapse in late 1930 showed exactly how dangerous the contagion had become. A bank called the Bank of United States, a private institution with no actual government connection, despite its official-sounding name, went under in December of that year, and it alone accounted for a third of the total $550 million in deposits lost across all bank closures in November and December combined. The psychological damage spread far beyond the depositors who lost their money. Between 1930 and 1933, more than 9,000 banks failed across the country, equal to roughly 30% of every bank that had existed at the start of that period. Depositors lost more than $1.3 billion, which works out to roughly $27 billion in today's dollars. And because no deposit insurance existed, every rumor about a struggling bank became a self-fulfilling prophecy. Depositors would rush to withdraw, that rush would drain cash reserves, and a bank that might have survived would collapse simply because enough people believed it would. Fear was both the cause and the accelerant. 3 weeks before Roosevelt's inauguration, on February 14, 1933, the state of Michigan declared an 8-day bank holiday, ordering every bank in the state to shut down. Michigan's banking system had been pushed to the edge, and the holiday was meant to buy time, but what it actually did was light a fuse that had been sitting there for months. Word spread fast. If Michigan was shutting its banks, what did that say about the bank in your town? Depositors across neighboring states didn't wait to find out. They withdrew everything they could, as quickly as they could, and state after state began declaring its own version of a bank holiday. Many states limited depositors to withdrawing no more than 5% of their own money, and even that restriction hadn't slowed the panic. What's worth understanding about the final days before Roosevelt's inauguration is how completely paralyzed the outgoing administration had become. Hoover's Treasury and Federal Reserve officials had already drafted emergency banking legislation. They knew what needed to be done. Hoover, for his part, refused to act unilaterally without Roosevelt's cooperation, and Roosevelt refused to attach his name to any actions before he was officially president. 2 men, one leaving power, one about to receive it, stood at the edge of a financial catastrophe and effectively did nothing while the bleeding continued. By March 3rd, New York had become the pressure point. As the financial center of the country, a New York bank holiday would mean the entire national banking system stopped functioning, and yet the city's most prominent bankers, even as the situation deteriorated around them, told the state governor they would rather, in their own words, stay open and take their beating. That posture lasted exactly one more day. Roosevelt's inaugural address on March 4, 1933 spoke directly to the psychological dimension of the crisis. The only thing we have to fear is fear itself wasn't just a rhetorical flourish. It was a diagnosis of exactly how 3 years of bank panics had worked. Fear caused withdrawals, withdrawals caused failures, and failures caused more fear. The following day, cabinet members sat down with Treasury and Federal Reserve officials to finalize a plan, And then at 1 o'clock in the morning on March 6th, just 36 hours after the oath of office, Roosevelt signed Proclamation 2039, suspending all banking transactions nationwide, effective immediately. No deposits could be paid out. No loans could be made. No foreign exchange, no transfers, no transactions of any kind. The legal foundation for the order came from the Trading with the Enemy Act of 1917, a World War I law that handed the president sweeping economic authority in times of national emergency. Here's something that tends to get lost in the retelling. The legislation Roosevelt used to formalize and extend the holiday had been substantially drafted by Treasury officials during the Hoover administration. Roosevelt's team added provisions, but the core framework had been sitting ready for weeks, prepared by the very officials Hoover refused to let act on it. The policy content wasn't new. What was new was the willingness to use it. Congress convened in special session on March 9th, and what followed was genuinely extraordinary. A single physical copy of the Emergency Banking Act existed on the floor of the House of Representatives, and Henry Stegall, the chairman of the House Banking Committee, read the entire bill aloud to his colleagues because that was the only way they could hear what they were voting on. Senators received their copies while the bill was already being debated in the Senate, after it had passed the House. Many members of Congress voted on legislation they had never read, and the bill passed and was signed into law that same evening. The act moved on several fronts at once. It legalized the bank closures retroactively, authorized federal officials to reorganize troubled banks, allowed the Reconstruction Finance Corporation to inject capital directly into struggling institutions, and expanded the Federal Reserve's authority to issue currency that didn't have to be backed by gold. That last point mattered more than almost anything else, because one of the core mechanics driving the bank run crisis was the simultaneous draining of gold and cash from the system. Freeing the Fed to issue unlimited currency to reopen banks was the government making a direct promise to every depositor. If you come back, your money will be there. The evening of March 12, 1933, the night before banks began reopening, Roosevelt sat down in front of a radio microphone and delivered what would become one of the most consequential broadcasts in American history. Speaking plainly, without technical jargon, he walked the country through what the Emergency Banking Act had done and how the reopening process would work. And then he said something that sounds almost disarmingly simple given what was at stake. I can assure you that it is safer to keep your money in a reopened bank than under the mattress. The broadcast worked, but not just because of the words. The substance behind the speech had already been put in place. On March 11th, Roosevelt had sent a telegram to the governor of the New York Federal Reserve Bank, committing the federal government to covering any losses the reserve banks might incur from emergency loans to struggling institutions. The government was backstopping the entire system, and the speech was telling the public what had already been arranged behind the scenes. New York Fed economist William Silber later described the combined effect of the Emergency Banking Act and the Fed's commitment to supply unlimited currency as creating, in his words, 100% deposit insurance. Even before the formal FDIC existed, the reopened banks weren't just open, they were, for all practical purposes, guaranteed by the federal government. The fireside chat made that guarantee legible to ordinary Americans, and the response confirmed that legibility was exactly what had been missing for 3 years. March 13th was the day banks in Federal Reserve cities received permission to reopen, but getting there had required a logistical operation that tends to be overlooked. Between March 9th and March 13th, the Bureau of Engraving and Printing had been running around the clock, printing emergency currency and shipping it to banks across the country, because the physical cash needed to be there before the doors opened. A government guarantee meant nothing if a depositor showed up and there was no money in the drawer. Banks had to apply for a Treasury license to reopen, and the license process was the mechanism that sorted the system. Solvent banks received their licenses and reopened. Insolvent banks did not, and about 4,000 of them never reopened at all. For the first time in American history, the federal government was directly deciding which banks were fit to operate. Deposits came flooding back at a pace that surprised even the officials who had designed the program. Within 2 weeks, nearly 50% of all the cash withdrawn during the panic had been redeposited, and by March 15th, banks controlling 90% of the country's banking resources had resumed normal operations, with deposits running well ahead of withdrawals. When Wall Street reopened on March 15th, The Dow Jones Industrial Average gained 15.34% in a single session, a record that, as of 2025, still stands as the largest single-day percentage gain in the index's history. Roosevelt's advisor Raymond Moley, who had helped draft both the Emergency Banking Act and the Fireside Chat script, put it plainly afterward: capitalism was saved in 8 days. The bank runs that had been destroying American financial life for 3 years stopped, not because the underlying economic damage had been repaired, 4,000 banks were gone permanently, and full recovery was still years away, but because the self-reinforcing spiral of panic had been broken. The bank holiday was designed as an emergency response, but what it set in motion became permanent. On June 16, 1933, Roosevelt signed the Banking Act of 1933, the Glass-Steagall Act, which created the Federal Deposit Insurance Corporation as a temporary agency. The Banking Act of 1935 made it permanent, and after the FDIC came into existence, bank failures dropped from the thousands annually to an average of just 50.7 per year between 1934 and 1940. Deposit insurance broke the internal logic of the bank run. If your savings were guaranteed, there was no reason to panic, and a panic that never started couldn't take down a solvent bank. Today, the FDIC insures deposits up to $250,000 per depositor, still operating under the framework built in 1933. The debates about what caused the Depression and what actually fixed it have never fully settled. Milton Friedman and Anna Schwartz argued that the Federal Reserve caused the depth of the crisis by failing to prevent the cascading bank failures, and that argument proved persuasive enough that Ben Bernanke, speaking as a Federal Reserve governor in 2002, honoring Friedman directly, said, "Regarding the Great Depression, you're right. We did it. We're very sorry. But thanks to you, we won't do it again." The question of Roosevelt's originality cuts in a different direction. The Emergency Banking Act was substantially Hoover's blueprint, assembled by Hoover's own officials and ready to deploy for weeks before Roosevelt arrived. What separated the two presidents wasn't knowledge of the problem or access to the solution. It was the decision to act, and the ability to make the public believe the action meant something. The 2008 financial crisis saw the government use a similar playbook, injecting capital directly into banks through the TARP program in a move economists directly compared to what the Reconstruction Finance Corporation had done in 1933. The mechanics change. The underlying dynamic, confidence collapsing faster than policy can respond, stays the same. On March 6, 1933, at 1 o'clock in the morning, every bank in the United States closed. 9,000 had already failed in the 3 years before that. More than $1.3 billion in depositor money had been wiped out. 1 in 4 Americans couldn't find work. 8 days later, the banking system was open again. Deposits were coming back faster than anyone had projected. And within weeks, the stock market would record its single largest one-day gain in history. By the end of that year, a permanent federal deposit insurance system had been created that still protects American savers today. What happened in March 1933 wasn't a solution to the Great Depression. The Depression continued for years after those 8 days. What it was proof that a financial crisis driven by panic can be interrupted by a government willing to act decisively, communicate clearly, and put real resources behind its promises. The banks didn't change between March 5th and March 13th. The loans were still bad, the assets were still deflated, and the underlying economy was still broken. What changed was whether people believed their money was safe. Roosevelt said on the day he took office that fear itself was the thing to be feared, and as it turned out, that diagnosis was exactly right.